G'day guys, welcome back. Episode 61, Money in the Tank. Thanks for the tankers for joining us again in what is sure to be a thrilling episode of all the up-to-date going on financial news around the world. There's been plenty to talk about and plenty of good ammunition for us to be able to divulge to our listeners. Always general in nature, of course, as per the disclosure that our friend Brad has knocked together as part of this podcast, but that's actually on YouTube, so it's only visual only. So we'd just like to mention it to you for those listeners out there on the podcast world, general in nature, educational only, but we sure do like to have a bit of fun with money and talk all things financial and try to help explain the goings on in the world and help the beginners and intermediates out there just to get a better understanding, and even maybe the experts, a better understanding of just all things financial going on in the world. So without further ado, my name is Joel Seach, Principal Advisor, Harpel FG. To my left, as always, which is the other way,
is Arnie, Finance Professional. Thank you.
You're down to me. And Brad Tabone, Investor.
Thank you, guys. And thanks for being back with us for episode 61, guys. So today we've got a range of different topics to chat about. We've got a great 50-50 from one of our listeners, which is fantastic, which Brad has given us a sneak peek of earlier in our preparation for the podcast. Yes, we do prepare for this podcast. We've got a great economic update from yours truly, which I do say so myself will be great, I'm hoping. We've also got a bit of a update on the latest going on of the Deutsche Bank and First National in America?
First Republic.
First Republic, I should say. There's so many firsts.
I'm not taking the $2 on that one, just letting you know.
Part of my economic update, there's 500 banks in America, which is part of it. So there's a sneak peek for that one. And then we've got some rapid fire news for Arnie as well today, which we'll be touching on as we go through the pod. So without further ado, let's get stuck into yours and truly's, if we can see it on the screen there, the Bible, Rivkin's Rules. So
before we do, Arnie, where we find us?
Yeah, get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook. And please leave a like, comment, subscribe, tick the bell, and it helps.
Tell your friends.
Tell your friends.
Perfect
Sorry,
segue.
Jolly.
Perfect segue. Well, I found the quote that hasn't been used. Unless human behaviour changes, fear, greed, and folly will always drive markets, in brackets, but of course, human behaviour won't.
I think we might have had something similar to this once before: fear, greed, and folly. And but I don't mind hearing it again, because last time I disagreed with that, and then after sort of thinking it through with Brad, in particular, I think it is fear, greed, and folly. But I don't agree with that last part of his quote.
What's the last part again?
Yeah, say that last part again.
So it says, unless human behaviour changes, for example, fear, greed, and folly will always drive markets. In brackets, but of course, human behaviour will not.
Won't change. Yeah, no, I'm sorry.
So he's saying human behaviour won't change.
Yeah, so therefore, fear following that will consistently drive the markets.
Okay, I get. Yeah, I agree with that. All right, Rivkin, well done. That's a good one, Riv.
That's a good one.
Yeah, I like his little in brackets bit. It's actually true. It's like human behaviour isn't going to change.
We are some of the worst decision makers when under stress or pressure in terms of making rational judgments. So I would agree with that from a behavioural perspective. Yes, I agree.
If anybody's ever done like one of those LSIs or psychometric testing where you do it, this is you and then you under stress, you all know that you under stress is definitely not the best version of yourself.
Which is why that sometimes people like to outsource to experts to help them make rational.
I love the segue there, Jolly.
When they're irrational about their money behaviour. But there you go.
That's true. It's true.
So great one there. So I guess getting on
economic news, Jolly.
Yeah, getting on to the topic of the economic news and updates. So I had a economic update the other week, and it was just an interesting one. There's a few dot points as an overview. So one of the things I was just never aware of is there's 500 banks inside of the United States of America, maybe more, but around 500 is what the Economist updated with. And one of the news articles I just read this morning is that there's some legislators in America looking at making the capital standards for banks in America. While I get that up in front of me, bear with me 1 second. There was an article this morning. Yeah, Brad, fire away while I'm getting this up.
There is about 2,300 banks, community banks, just community banks in America.
Just community banks. So maybe she's just mentioned, or the economist has mentioned 500 maybe banks that meet a certain standard, but obviously, yeah, 2,000 community banks. So it's a completely different, or it's a foreign thing to Australians that have just been used to our banking system, which is, you know, four majors,
4+5.
yeah, plus some second tiers and whatnot. But yeah, it's a completely different system. So they privatise their banks over there, and you got your regular, you know, regional bank that's set up as a business.
So all up, 4,200 FDIC insured commercial banks.
Yeah, it's
a lot of banks.
A lot of banks. So the article I read this morning was the bank stocks, they slipped on Tuesday following a contentious hearing at the Senate Banking Committee. So 3 top regulators each said they favour more stringent rules for banks with more than 100 billion in assets, which I guess, you know, may have helped save this issues with Signature Bank and SVP, because they were falling under technical definitions of regional banks, I believe. So, which means their requirements for capital reserves wasn't that of maybe the bigger banks in America. So it's just an interesting setup, and that's again part of the reason that Australia can be a little bit immune to some of the banking issues that go on, is because we've got those 4 big pillars, which is a pro and a con, but in circumstances, but it avoids Australia being hit under, I guess, these same pressures that's going on in the States at the moment. Brad and Arnie, any thoughts on that one quickly before I jump to the rest of the economic update?
Yeah, I'll jump in first here. I think I recall around the 2008 crisis, Kevin Rudd at the time, or his administration, his government, also put a bit of a guarantee in place around our big 4 banks, and I think that holds to this day, which is basically a similar thing to what the US is discussing now, albeit with a lot more players. And it just gives the market confidence that if anything were to go wrong in Australia with one of the big 4, you know that you'll get looked after. So. And I think off the back of that, back then, immediately Standard & Poor's and Moody's upgraded all 4 of our banks to AAA, which was consistent with our country's credit rating. So I guess it's just, I don't know how they're going to do it in America, because I also saw some stat floating around that to insure all of the deposits in America, it's like $17 trillion. So I think they'll have to think of a creative way to do it. But yeah, I think it's a good thing. What do you think, Braddles?
One thing, SVB did have over $100 billion in capital reserves, so that would be a bank that doesn't fall into that category in terms of under. The problem with
I think that was still classed as regional from one.
Still a community bank, but they did have over 100. So, like, I'll just look at an article about the legislation. They're looking at 2 things. One is the capital reserves over 100. The other one is percentage of depositors. So the problem with a lot of the banks that have been going under, which I'll touch on later, is the percentage of their depositors that have over $250,000. That was the problem with the community banks, and so they're just tapping kind of like big corporates, etc. And when you have a very small percentage of depositors, a lot of money, that's when the bank runs can occur in a much more less than, say, JP Morgan, which has, I think, 60-70% of bank balances under $50,000. Sorry, Arnie, go.
I think you and I touched on this last week, Brad. Well, maybe it was the week before. Maybe Joel and I also touched on it last week, and I forget what we did. But
it's all
I think there's been so many banking episodes, and we're talking about this all the time, that I'm sort of getting lost here. But I think SVB in particular, and I'm wondering if insurance of depositors is actually the way that America should go. I think a better course of action is actually more maybe regulation or legislation around how banks manage their risk, because a big part which you and I discussed was the fact that they had no hedging in place, Brad. So
yeah,
I do wonder about that part of it. Yeah, and just that's where I think it should be going, because I feel like you can't insure that much money, and I don't think you should have to. It makes no sense to me that you would force people to put $250,000 in like 10 different banks if they have that amount of money.
Yeah, and some people in Australia did that. Like, we see some clients that did that at the time, and I guess it bodes well with the point in terms of Brad mentioning, the SVP holding over $100 billion in assets, and why weren't they potentially held to higher account of more stringent rules? That's a fair bit of money to me. So to be classed as a mid-tier or a second-tier bank over there, or just a regional bank, and falling out of that capital requirements, because it does come down to that. I think it comes down to, I guess, capital requirements that are required to hold to get confidence in the consumers that our bank's strong and we're going to be okay. And I think in Australia, speaking domestically at the time, the government knew that it was never going to be called upon with our banking system, because we've just got such a different system and such a strong system with the capital ratio requirements. That 250k thing was more just an instill of consumer confidence that 250 in each bank. So people did split them up to different banks, but it was probably never going to be tapped into. So more to your point there, Arnie, I think overseas in the States, rather than having to rely upon insurance, should it be more of a systematic approach to get this regulation right, so that insurance doesn't have to be there as a bailout, but to say that our requirements and our regulation are more stringent now, and it's going to be better served for the consumers and the banks moving forward.
Yeah, so to cover there, I think, Arnie, your point on the simple amount of money that would be needed to cover all banks in the US was around the $17 trillion mark. And I think that's why you had the Coinbase CEO make the bet that Bitcoin would be $1 million in June, because he believed that the reason. So two people took on, the former CTO, of Coinbase, made a bet last week, just for tankers, if you want to know something funny. He put it out there, and two people took him up on the bet. So in escrow, he put $1 million and $1 million, and they had to put one Bitcoin in each of the escrows. And the deal is looking at, I believe, the date of June 30th. He believes that over the course of the next 2 months, the American government will be needing to stand in, and because of the $17 trillion worth of deposits that they'll need to insure, it's going to print more money and create hyperinflation. And again, that's just like an interesting thing out there that was discussed, I think, on the kind of Friends podcast with Chamath and all that last week, and it made all news last week. Now, a few people are thinking that he's holding all his money in Bitcoin, and any minor movement up that this causes, because he's going on TV and everything at the moment around the circuit in America, he might not be doing it for necessarily like $2 million would be nothing compared to kind of like a 5% increase just from some people that believe him. But that $17 trillion number is a real number. And lastly, agree with you, both of you, Arnie and Joel, that I think it's more around the risk mitigation. So here in Australia, I think it's much easier because we've got the 4 pillars policy. And obviously we have some other banks, but generally speaking, a neobank or whatever gets created gets sucked up into one of the big 4 anyway, eventually. Much easier to regulate 4 banks than 4,200 banks. And I think things like, I think it was under Trump, where bonds of government and companies could be used as tier 1 capital, was a mistake, because they wanted the banks to be buying more bonds, and so they actually introduced that to actually facilitate them to buy more bonds. And so, yeah, look, I think more regulation and risk management, because you can't have a portfolio. SVB would be the second biggest bank to fail in history,
which shouldn't be the case.
It had zero hedging.
Yeah, it shouldn't be the case. So
never the case. But anything else on the?
Yeah, so a bit to look into there, but so SVP, which filed for bankruptcy, is trading at 40 cents per share. It closed at $106 per share on March the 9th before the bank was closed. And then Signature Bank was trading around 13 cents per share, down from US 70 before its closure. So that's it for the banking stuff. But in terms of just the rest of the economic update that we got, so the interest rate expectation in America may get to around the 5% mark. I think it's very close to there now, if not there now. They say neutral in the US is more 3.5% to 4% because it can sustain higher interest rates there, whereas domestically the RBA, the Reserve Bank of Australia, their prediction is potentially no further rises, and a neutral rate for us longer term is 2.5% to 3%. So that will be interesting to see if we don't see any further rate rises here in Australia. Volatility will come, and it depends how heavy the recession is. If the recession does come, inflation's still too high, which obviously it's quite obvious it needs to come down. But will the recession come, and how heavy it'll come, and how deep it'll come, and how long it may come for, will then be one of the determining factors as to how volatile the market goes, the stock market. So the US has a higher issue with inflation, with just service wages growth inflation. So wages, they need to slow the labour market down. It's still too tight. Unemployment rate in the US needs to be on a downtrend. Australia unemployment has plateaued and it's rising. So as we spoke about in a podcast before, unemployment or some part of unemployment is not a bad thing, because it means that there's potential, there's not a tightening labour market, which means there's just less jobs available. There's more jobs available per person, which pushes up that wage growth. So you want to have a bit of a mixture there, a bit of unemployment. So that's rising now, which is good. The share market from the peak in the US is down 20%, and Australia, I believe, is around 7% down from its peak. So that's sort of just some of the economic updates that we got the other week. So it's just thought I'd share that with the podcast, just to give a bit of a macro view on mainly the US, obviously, and Australia.
Good update. Yeah, good update, mate. I think you're right. They have raised their rates another 25 basis points, so they're sitting within the range of 5 to 2.5 now.
I think they're 4.75, aren't they? Or are they up above that?
Oh, maybe it's 4.75 to 5.
Yeah.
I haven't.
I thought it was 4.5.
Don't fact check me.
Yeah, I thought it was 4.5 to 4.75.
Yeah, you're probably right, but I think they're indicating they're going to go again. Maybe that's why I've got that. Maybe that's why I got that number in my head. But anyway, yeah, no, good one, Jolly. Good update. So, I got nothing.
No, you're right. 4.75 to 5. Yeah, fact checked. Always got a fact check. So it's gone from 4.75 to 5. We're sitting at 5. Big Jolly's right.
Yeah. 5.
Right.
We were all right? The middle was 5. we got it.
Got there in the end. So economic news, love it, Jolly, love it. First Republic Bank and Deutsche. Real quick update. So last pod discussed First Republic. Just one little tidbit more information for the tankers, because we'd love supplying all the information and let you make your own decisions. One of the big causes of First Republic Bank's current woes, and the reason why, even though it got $70 billion injection, $30 billion injection, didn't get access to the $25 billion dodgy bond buyout. But the reason why a bank like that with so much cash injection is still facing the guillotine is because of the makeup, and we talked about this just a little bit earlier on the show. It's the makeup of their depositors. So I looked up some numbers, because I heard on the radio it was a bit higher. I looked up some numbers then. Around 70 to 75% of all depositors at First Republic Bank have accounts over the size of $250,000. And because the FDIC only guarantees up to $250,000, the bank classes itself as a high net worth bank. It serves Silicon Valley kind of bank customers, i.e. like Hammer Tech. When we got our Series A, $10 million, that gets put into an account, right? It also serves founders and all the rest of it. So some of these guys that sell their companies for a unicorn, they dump their money into the bank. Generally, high net worth clients have a greater idea around mismanagement, I would say, and because they're sophisticated investors, some of them, and they also have the ability to move their money around much easier because they've got money managers and private bankers and all the rest of it looking after themselves, like a Jolie. And so, if you had a customer that had their net savings of $10 million in a bank, and the bank only guaranteed the first $250,000, but you had another bank in the country that guaranteed all of it, and there's no reason they need to leave their money there, would you be recommending that they move their money?
Yeah, well, you're taking the play of less risk and least resistance, and playing the game as to what the rules are set up to be played by. So,
right, and that's literally the reason why there's a bank run there. Is it's not that the bank's faltering or it's bad or anything like that. It's just that people are saying, why would I take the risk if I don't need to take the risk on my money? And it's as simple as that. And that's why they really need that kind of government guarantee to come through. That's the only thing that will stem the risk from First Republic, unless they collateralize the entire amount somehow. And that's what they're probably where they get bought out by JP Morgan or something like that. And then therefore they'll be a part of JP Morgan, and then the FDIC kind of doesn't doesn't apply. JP Morgan will cover the whole amount. And then Deutsche. A little bit more information around what's happening with Deutsche Bank for those that have heard Deutsche Bank being the latest domino. Just a little bit of information kind of we've been reading up on. We're not sure about it, but it comes from Bloomberg, so I'm going to put it out there. It looks like the credit default swap spike that started sending the Deutsche Bank kind of credit default swap price, which is kind of an indication of the markets of, I guess, their chance of defaulting and the other costs to kind of hedge against it. It started climbing, not to the rate of Credit Suisse, but it started climbing. And it was due to a £5 million bet made by a trader on the junior, so the 5-year credit default swap for the bank, which is like the short term. And because, and again, I'm not going to pretend that I am a market specialist around credit default swaps. So I will throw to Arnie and Jolie in a second if they are. I'm just asking questions anyway. But supposedly credit default swaps are highly illiquid, and so therefore a $5 million pound, £5 million bet could actually move the markets significantly. And so governments have gone back to banks and kind of started talking to them about such things and creating fear, because that seemed to have triggered, post that £5 million bet, triggered kind of some of the bank runs and the current issues with Deutsche Bank. So, throwing over to Jolie and Arnie, your thoughts?
Do you want to go first, Jolie?
Yeah, well, I guess probably just to put a high-level overview, because I haven't delved into the Deutsche Bank as much of late, but it's that article, or sorry, the Rivkins we read about today is fear, greed and worry, or stress and people trading on the back of that. So yeah, obviously something's triggered that credit or the credit default swap trade, and then that's created fear, concern, worry, and that's what bank runs occur or trades down in stocks occur. So it may not be rational thought, it might not be behavioral thought behind it, but it's more of an emotional run or an emotional trade. So that's probably just my 2 cents on that.
I think my 2 cents on it, and again, I haven't delved deeply into this, but I think this is what I think occurred. When you first told me, Brad, that it was a single trade of £5 million to trigger it, I thought that's ridiculous. How could a $5 million trade, even in a credit default swap within a liquid market, trigger this? But then sort of thinking through the implication, all of these financial institutions that are involved at that level and have access to instruments like credit default swaps wouldn't be relying on, like the majority wouldn't be relying on human traders. They would have algorithms set up. So if it isn't a liquid market and you see one outsized trade, so if the average trade is a couple $100,000 or whatever, I don't know what it would be, and then a huge one comes in like $5 million for one trade, the algos might see it, spark a huge sell-off in the credit default swaps, and then it just becomes a snowball effect. So that must be what occurred there. But that just blows my mind, because Deutsche Bank, again, maybe not the most, maybe not the best reputation, similar to Credit Suisse, but they're still a huge bank. So, and they're a national bank. So you would imagine that they have, a lot of assets and a lot of, tier one reserves and capital. So interesting to see what's happening with them. I want to do a bit more research on it, but the share price has tanked. Yeah.
It is funny that so Deutsche Bank, as of 2022, is the 21st biggest bank in the world. Credit Suisse, and I stole this one from our favorite ex-hedge fund manager, Patrick Boyle. They were number 8 in 2007, and they're 150 now. So Deutsche Bank much bigger. And I think
what are the big 4 Australians rank? I remember previously they were sort of some of the 4 of the top rated banks in the world, top 20, I think, back in the GFC days. I'm not sure what it's changed to now, but historically, I know the Australian banks have been quite high up in those figures.
Let's have a look.
Yeah, I don't know. I do recall us being big as well while Brad finds it. I do know that we have interests in a lot of overseas ventures. Go ahead, Brad.
No, you got it.
I was going to say, I know we have a lot of interest in overseas ventures, so I wonder if they count that when taking into account the size of our big 4 banks. Like if they count the the ones we own overseas, or if they count those independently.
And then
Yeah, I'm just having a look down the list. China obviously takes over a huge part of the top 15.
yeah,
It's pretty crazy. But Australia comes in at, so we all fall in the top 60.
okay.
Westpac 56, ANZ 50, Commonwealth Bank 44, National Australia Bank 61. So yeah, I mean it's pretty massive. All four of them in there.
Being one of the probably 2% of the GDP, or 1% of the world's GDP in terms of size of a country, it's to have 4 of the top 3%, to have 4 of the top banks in the top 50, so to speak. It's quite an impressive record. So and the Deutsche Bank's German based, yeah.
Yeah.
And have the German government come out with any updates on any intervention there at all that you guys know of? If not, we can come back next week to chat about that.
I think we need to come back. There's just so much bank news. I haven't kept up with Deutsche Bank, mate. Yeah.
Cool.
And also, just remember that the political situation changed from the old LAS into the new same party, but they've gone a little bit more less socialism in the country lately. So it'll be interesting to see. I think like Deutsche Bank chief warns politicians against raiding the bank. So we'll see what happens because if they see a problem, I'm sure they will jump in there. But yeah, you're right, Arnie. Probably another day.
How's the form on the Deutsche Bank? Oh, sorry, Jolie. How's the form on the Deutsche Bank chief saying "Don't raid us"? Like, oh yeah, that's confidence inspiring stuff right there.
Because the Swiss government came out to, I guess, work the trade through with Credit Suisse, didn't they? And the name eludes me, the other insto that took over.
UBS.
UBS, yeah.
Yeah, UBS. So on to confidence. Portfolio. So I mean, we'll make sure we'll keep this one tight because we have talked a lot about the first two, but let's have a chat and go around the pod around. I guess what do you think around the short to medium term in your portfolios? What do you see in the good, the bad, the ugly? Just always good to do a bit of an update. I'll throw to my left, Jolly.
In terms of the market update as to the goings on.
What are your vibes and feels at the moment, Jolly?
Yeah, I think probably on the back of that economic update.
General advice in nature.
General advice, as always, general in nature, education.
Everything just general.
All that good stuff. On the back of that economic update, I sort of agree with the economists, and I don't always agree with economists, but I think, and it's easy to say the year will be a volatile year, and I think it'll depend on how, how the world either goes into recession or maybe avoids a recession in certain cases. Like I think China's nowhere near a recession because they're just coming out of their lockdowns. But how deep America might go into a recession, Australia on the back of that, and then how long it lasts for. How deep and how long will then be the determinant as to how volatile the market is. Now, the market will be factoring in day-to-day information already as to where they feel the recession may end up, which is why we've already seen so much volatility, because that changes on a day-to-day basis as to what comes out with the Federal Reserve or the RBA tightening, being hawkish or loosening, easing monetary policy. Because we saw that the markets, or the later in February, the markets had run well. We're looking like that we were still going to tighten for a bit longer, but they were reining in inflation, and then something pops up like the banks. So something always pops up in the market, and you don't hear much about Russia, Ukraine at the moment. It's just not in the media and it's not on the news, but that's going on in the background too. So there's so many different variables. But what I would say is that, I think hold on for a volatile ride for 2023. I still think there's some upsides there, and I think I shared a chart last year of the financial year of 21-22 with all the assets a lot of the major asset classes being smashed. So we may still have some volatility, but you're at least now getting some return on some cash. You're getting some return on some bond funds where they were negative for the past year. So Wait and see. Sorry, I couldn't be more precise, but I think hang your hat on where the recession will be, how deep it will be, if it does come, that is, and then that'll then determine the market volatility it will experience.
So, Jolie, last question. If and I know the answer, but I'm just going to ask a question anyway. So, if you had someone with some money at the moment that was looking to put some stuff into the markets, would you be saying go into the markets? Would you be saying, obviously seek financial advice and the rest of it? Would you be saying that's a good time to get into the markets, a bad time to stay away from the markets, or just kind of enter the markets on a regular basis with dollar cost averaging?
Yeah, it depends on your time horizon.
Sorry, I know the question was very limited in the.
Yeah, that's right. So it depends on your time horizon and then your profile of your risk appetite that you want to take. But like generally, what we've been doing with clients is we'll tend to be spreading through. We may, look at investing half initially and then spreading the rest through a period of months to years afterwards. So you're minimizing your risk as you go into the purchase, and you're sequencing risk in that regard, and you're dollar costing through, but you're also getting a bit in up front, because it's really hard to know. We always just say that no idea over the next 12 to 24 months what a portfolio may or may not do, but we know that if we've got the time horizon there, say 4 or 5 plus years, 6 years plus, then we're going to do very, very well over that period of time. And I think that was a quote from Warren Buffett years ago during the GFC, that he was buying the bank. I think he was buying JB Ware at the time, and he said, I've got no idea what it's going to do the next 12 or 24 months, but he knows that it's going to be a good long-term purchase. So, yeah, so that's probably my answer to that one.
Only we're all like Buffett. And to my right, Arnie.
Yeah, thanks, mate. I think general in nature,
General in nature for me too, Arnie, and that one before.
It's always general. Yeah.
Seek your own personal financial advice.
I'll come to see you. No, general in nature. I think, okay, so we've covered like the market sentiment a lot. I do think we've got a crash on the horizon. My portfolio is spread across like everywhere. I've got like a lot of US stocks, Australian stocks, Europe, UK. So, but I think I see like America in particular suffering a recession or a crash in the near future. So I'm kind of wary of what I am buying, if anything. But as is always the case with my investing philosophy, if something hits a very attractive price, based on like a time horizon of 10 years plus, I will probably dip my toe in. I wouldn't go all the way in, and yeah, nothing.
You would dip your toe all the way in?
No, I mean, I would. Maybe I would. It depends. Like, in a way, like when I start a position, I like to start with a small position, and then I don't mind adding to it if the price goes up. I love adding to it when the price goes down. If I've got conviction in that particular investment. There's nothing at the moment that I've got a lot of conviction in. One, which I don't know if I've mentioned this on the pod before, but one which I've taken a beating on is PLBY Group, which is Playboy. And if you look at the sum of the parts of that business, it's worth a lot more than its current market cap or enterprise value. They do have a lot of debt for a small business. It's probably considered a penny stock at the moment, and it's a de-SPAC. So it had some issues with the SPAC costs and warrants and the stock-based compensation. But in general, I feel like that is a brand that will grow and compete in that industry with the major player, which is OnlyFans, which is still private. But that is a very profitable business. Because you can see some of their figures. It's not public, but you can get access to some of them. So I do wonder about that one. And I have averaged down that one. But yeah, but there's also that's a risky one as well. I feel like that one could I guess it's more of a play of like, do I think that one will go bankrupt, or do I think it will survive and thrive? And yeah, I'm in the latter. Interestingly, what I have done with my cash position is until very recently, until the last rate hike in the US, it was all held in US dollars. I've swapped that over to Australian dollars, because I think that in the near future, America might have one more rise left in them, but I feel like sooner or later they're going to have to cut. And I don't know if we will here as soon as they do. I feel like the banking stuff, depending on what goes on with that could be a catalyst for them to cut sooner rather than later. So, and in terms of property, we were meant to like sell our primary residence and buy a new one. Now that the market's dipping, my mind is sort of turning to, can I hold on to this one and get another one, and sort of manage them both? So I don't know if that's a possibility, but that's where my mind's going in terms of the Australian market. So that's what I'm looking. And you, Braddles?
Me, look, obviously you all know my thoughts on some of the pessimistic things out there in the world, but I'm trying to balance it, because again, I think we mentioned that once the news cycle starts going all positive, I start thinking negative, and once the news cycle starts turning all negative, I start looking for some positive. I just try and always look at the opposite of what's going on in the news cycle, because generally the news cycle is like an economic lag indicator, in my opinion. But there's going to be pain, no doubt. And I think, have we felt all that pain? No. But do I think the pain's probably going to be as bad as the doomsdayers that are coming out now? No. So I start trying to look at some things, and so just some general stats, like corporate debt. Last year had repayments of 800 billion. This year is down to 450 billion, right? So there's a stack less corporate debt. Labor rates, generally speaking, low worldwide and have been quite resilient. There's a few reasons you can look into that. I'll leave that for another day. Asian countries, so Southeast Asian countries, including India, but like Indonesia and these kind of up and coming huge countries, still got GDP growth of 4.5 to 5% with low inflation of between 2 and 3%. Medium wealth countries, so I think it's G20 or maybe even top 40. Can't quote me on it. But inflation has popped from 6% down to 4% across. I know that in the US and the UK, etc., it's higher, but across kind of your top 20, I think it is countries, it's down at near 4% off the high of 6%. Gas prices, which was causing a lot of the problems into Europe, a lot of the kind of cost for manufacturing and businesses going under and a whole bunch of stuff, has been completely curtailed by a bunch of the LNG facilities that Germany somehow got up and running in a year. When, just for tanker's sake, the LNG facilities that Germany have got put in place to be able to receive LNG. So when it's a gas, it needs to be liquefied to actually transport it, and then de-liquefied and entered into their gas system. They've built as much infrastructure as Australia. It took Australia 12 years in WA to build what they built in a year. So obviously under wartime kind of stuff and all the rest of it, but pretty interesting. So I think whilst there is some pain to come, and like Jolie mentioned, we don't know what's around the corner. No one gets SVB, no one gets this, no one thought this might put a pause on rates or might have to do depositors. So there's always going to be some more news.
One thing we can guarantee, Brad, as you just mentioned right at the end there, is we can guarantee there'll always be something.
Oh yeah, I can guarantee there will be, and I say this to like everybody. It's like everyone's trying to predict the future based on what today is plus historical past and the rest of it, but human nature has this really awesome thing of just being unpredictable, and so you just don't know. Like the war could do something different, another country could invade another one, something awesome could happen in technology. I mean, GTP4 is going mental, so we don't know what impact it's going to have. So I'm always looking at what are the bright sparks and where are the good things that might happen, because the Southeast Asian countries are huge and they're going to be huge, and they are going to be resource hungry, and we are right there. And so Australia may benefit once again, like the GFC, maybe not from China, because China's manufacturing numbers are way down, because they're getting moved to these countries. Fact, because the cost of developing something in China now versus say Indonesia is a 4-to-1 ratio more expensive in China for labor. So that's my take. What am I doing at the moment? Really quickly, I'm sitting in cash for a fair bit. I'll be looking to get into some property. Looking to get into 3 properties probably by the end of this year or early next year. That's kind of the target I'm doing at the moment. And I'm slowly just buying into resource stocks, oil and gas, and other resource stocks. Just each month, just putting a little bit, doubling a little bit in there, and dollar cost averaging.
It'd be an interesting one just to tack on the end of Arnie's and your property mention there, because I didn't touch on property, and I do find it intriguing. Property domestically here anyways, Victoria, I've just seen the auction clearance rates still quite, or they come back up, they're quite high at the moment, or in the high 70s, I think I saw on the weekend. For Melbourne, the market's come down. I think Melbourne's come down about 10%, but a lot of it's in the back of low supply. People aren't selling much at the moment because the market is down. So then it's pushing these auction clearance rate higher on a supply-demand factor. So wait and see what happens if interest rates plateau and then potentially start coming down, and we're getting more international travel, tourists, people coming in, demand for property increasing, demand for rental supply, investors coming back in. Watch this next 12 months, 18 months of property. I think, yeah, there's some opportunity there at the moment with the market still in a bit of trepidation, but we'll see.
I will just finalise that one. Interesting. I just got my mum to sell her property because she's gone overseas for a while and want to kind of move her places. But I was pleasantly surprised. She's basically still getting peak market prices out near Frankston. So kind of she got an offer on her property. She won't go to auction this Saturday. She's got an offer before, and it'll be kind of the highest price for a kind of a detached kind of a 3-bedroom detached kind of unit in Frankston. So I mean, there is still, that's Frankston. I thought, you know, outside of the inner city areas, it might be down, but there's still some strength in the property market. Jolly.
Yeah, you'd be fooled in terms of people that meet that's saying that the markets are soft everywhere and everything's down, but no.
Was one of them.
Yeah.
So I was like, well done, Mum. Good on you.
Maybe and regional will do different things at different times to your status quo Melbourne or your Sydney. When you hear property in the media, they're generally just talking about Sydney and Melbourne, and that's it.
Yep. All right.
Cool.
Rapid fire, Arnie.
Rapid fire news, boys. All right, here we go. So Biden still supports a price cap on Russian oil. The Fed's bar said depositors are safe. This is all pretty recent. Fed's bar safe. Yeah, that's just what he said. Most banks are safe as Australian houses. No, hang on. Fed's bar. Most banks are highly effective in managing interest rate risk, liquidity risk. What he left unsaid there was some are not. US judge has approved revised bail conditions for the FTX founder Sam Bankman-Fried.
Idiot.
FDIC's Greenberg says regional bank liquidity in the US has remained stable. US has said that they will not share data on nuclear forces with Moscow, and the Wall Street Journal said that moves following Russia's decision to suspend participation in the New START treaty. McKinsey is cutting 1,400 jobs this week. OPEC Plus has reported they are showing no signs of changing their oil output based on their meeting coming up next week. What pod would be complete without me mentioning Elon Musk? He has said,
you do, because that's usually the last person you meet. You mention, right?
I got one more.
Okay, now you go.
Elon Musk has said in a private email or something, or communication to Twitter employees, that it's now valued at $20 billion. This is based on their employee share scheme. So he's lost over half of what he paid for it. And people are finding humor in that. And the last one is touching on the housing market, actually, and touching on international students and their effect on the housing market. I saw a tweet during the week which said that at an auction in Canterbury, I don't know if this is in Melbourne or in Sydney because there's a suburb called Canterbury in both, but an international student has pushed the price of this auction up to $5.1 million to buy this house. And it's a run-of-the-mill joint. I've had a look at the photo. So it's interesting, the pockets in Melbourne. And anecdotally, my auntie just sold her house in Lilydale. Yeah, seemed like good price there as well. Anyway, that's my last one, Brad. Back to you.
I was going to let you finish on Elon. Two really quick ones. So Binance has been some massive drop in Bitcoin price, which has risen from about 18,000 US to about 28 recently. Massive news on Binance. So I'm going to get it wrong. It's not the SEC because they go after small fries. It's the CFTC. They only go after the big ones. Have basically put forward and suing top crypto exchange Binance for illegal exchange and sham compliance efforts, because all controlled by one person in the US. Huge news because they usually just wipe the floor. It's not like the SEC. It's not like Gary Gensler. So Bitcoin dropped, 5-6% off the back of the news. And Sam Bankman-Fried is now in trouble for paying off China $40 million. So he's in trouble in China for bribery charges, for paying off Chinese officials. So
I saw that one actually. I thought I had that in my news. I just checked and I didn't. It was $40 million. Yeah,
$40 million. Yep,
Isn't that how they do business there?
it is indeed, Joel. But it would be fine if he was fine. He's not fine, so now the people and guarantee you he would have given probably 80 million, but the 40 million went to some people that are in good positions. The 40 million's in some people that are needing some dirt on them, so they're done. I love it. It's like Game of Thrones on crack.
Great. Well, thanks for the update, guys. And I know we're running short of time, so listeners, feel free to reach out to us for any questions you may have and any topics you may have. And we've got a listener 50-50 this week that's been thrown in that Brad is going to announce in just one moment. And Arnie, why do we do 50-50s? And then tell us as well where the listeners can get us at.
Yeah, we do 50-50 because as in investment, as in life, everyone has different choices to make, and there's no right or wrong way to go about it. So we like to use our 50-50s to highlight the differences in people. And if you want to get us and send us a 50-50 or a Q&A, please get us at Money in the Tank on YouTube, Twitter, Instagram, and Facebook. And so what is this one, Brad? I'm excited about this one.
This one. All right. So hopefully those out there kind of have some knowledge of chess, but if you don't, play along and learn. So if you were a chess piece, either a knight or a bishop, which are worth the same amount of points, knight moves 2, then 1 to the side. Bishop moves diagonally as far as they can go without blocking. What would you be?
I'll go first if you like.
Because a knight can actually jump over people as well, everyone.
Yeah.
Bishops can't.
Yeah. I think like if you were if you're basing this on like pure effectiveness, even though they're worth the same amount of points, there's been a lot of study done because of
chess master.
Yeah, because of computers like mastering chess and things like Stockfish. People now say that bishops are actually worth more. It should be worth half a point more. Like in theory, if a knight is worth 3, a bishop should be 3.5, and it's a stronger piece. However, I think that a knight is the more exciting piece and comes up with the more exciting positions and forks, and therefore I would be a knight if I had to choose.
And you're a knight.
Arnie's the main chess player out of all of us.
Can you tell?
Yeah. So as a young bloke growing up, I did enjoy the bishop because I felt it looked cool and it could go a long way. So I used to like playing my bishop, but as I've gotten older, the limited time I do play chess, I feel the knight is more of a piece that you can catch people out by. And position on the board, the knight is outside of the bishop. Is that right?
Yeah, it's one outside of it.
Yeah. So there you go.
There you go. Look, you guys have covered my points, which is I think the knight is able to set up things that people can't see more than the bishop. And so therefore always be an exciting little, game maker. So it'll be 3 knights. Look at us. Three musketeers, one might call us.
Thanks for the listener 50-50 as well, and not food related. Always a surprise when it's not food or event related, but I'm sure we'll be back to food next week. As with always, guys, thanks for coming in today. Thanks for the listeners for the questions and for tuning in. Arnie's got at you where you can reach us at, and we look forward to continuing to bring great content and all this crazy market updates for you guys. And as mentioned, we've got some guests lined up for this year too, which will be come on and talk about some special subjects that you guys want to hear about. So keep tuning in, keep subscribing, and we look forward to bringing episode 62 to you guys next week. But for now, goodbye and have a great week all.
See you later.
Is that all?
Bye.